Someone wrote the words, "The world's largest hedge fund is a fraud," at the top of a document and handed it to the United States government. Not buried in an appendix, not implied in a footnote in the title. That was 2005. The collapse came 3 years later. There's an agency in Washington whose entire job is to examine the firms that hold your money. It examined this 5 separate times. 3 examinations, 2 investigations. Every file was opened, staffed, worked, and closed. And here is what removes the comfortable explanation. The agency later investigated itself and found that nobody had been paid off. No bribes, no favors, nothing bought. The people whose job was to look were looking, and they saw nothing. So, what were they actually looking at? Who wrote that document? And how does a man send 6 warnings over 8 years and change nothing? And the number everyone repeats, $65 billion. Where did that figure actually come from? Before any of it, you need to understand what happens when this agency decides to check. There is a building in Washington whose job is to look. The Securities and Exchange Commission examines the firms that hold your money. It sends people. They ask for records. They compare what a firm says it does against what it actually did. That is the promise. Somebody checks. Now hold 2 facts next to each other. Between June of 1992 and December of 2008, the Securities and Exchange Commission opened 5 separate matters into Bernard Madoff's firm. 3 examinations, 2 investigations. Every one of them closed. This is the part most people have backwards. The story is not that a warning arrived and nobody read it. The story is that the warnings arrived, were read, were assigned to staff, were worked, and the file was shut. 5 times, over 16 years. The agency said so itself. In August of 2009, the Securities and Exchange Commission's own Inspector General published a report on what had gone wrong. One sentence in it does more damage than anything a critic could write. The result was a missed opportunity to uncover Madoff's Ponzi scheme 16 years earlier. 16 years? And the same report closed the door on the easy explanation. It found no evidence that anyone at the agency had a financial or improper connection to Madoff or his family. Nobody was bought. So, the comfortable version is gone. This was not corruption. It was procedure. Working exactly as designed, arriving at the wrong answer 5 consecutive times. Which leaves a harder question. If the people whose job was to look were looking, and they were, what were they looking at? Everything in this episode is in public documents. The submissions, the Inspector General's own report, the sworn testimony. If that's what you want more of, subscribe. The next case is already public, and nobody read that one either. In 1999, a firm in Boston asked one of its people a simple question. A competitor was posting steady returns month after month, almost never down. Could we do that? The man they asked was named Harry Markopoulos. He was a quantitative analyst. His job was numbers. He was not a whistleblower. He was not a victim. He had never met Madoff. He was a competitor sent to reverse engineer a rival's product so his own firm could sell something like it. He couldn't. The numbers didn't reconcile. So, in May of 2000, he wrote it up, 8 pages, and took it to the Securities and Exchange Commission's Boston office. Nothing happened. In October of 2001, he sent it again to the New York office, this time expanded with a section explaining how the strategy was supposed to work. Nothing happened. On the 7th of November 2005, he sent a third document. He did not bury the conclusion in an executive summary. He put it in the title. The document is called "The World's Largest Hedge Fund is a Fraud." 6 weeks later, he sent an updated version, 32 pages, then 2007, then April of 2008, count them, 2000, 2001, twice in 2005, 2007, 2008, 6 submissions to 2 offices over 8.5 years from a man with no stake in the outcome and nothing to gain. Now, what was in them? The claim strategy had a name: split strike conversion. Buy a basket of stocks, hedge them with options, respectable, unremarkable, and easy to describe to a client. Markopoulos ran the arithmetic and found something the strategy could not survive. The volume of options the firm would have needed to hedge the money it claimed to manage did not square with the options market that actually existed. The trades weren't hidden. They didn't ADD up. And this is where the episode stops being about one man. Because Markopoulos was not the only person who ran the numbers. He was only the one who mailed them to the government. The Inspector General's report catalogues what other people in the industry had already worked out, using nothing but public information. Due diligence emails inside sophisticated firms flagged Madoff's unusually consistent non-volatile returns over several years. Another flagged what it called incredible and highly unusual fills for equity trades. One of those firms was Renaissance Technologies, the most successful quantitative fund in the history of the market, staffed with mathematicians and physicists whose entire business is finding patterns in prices. Their internal emails cited Madoff's secrecy, his auditor, and what they described as his misrepresentation of his options trading. They didn't report him. They reduced their exposure and said nothing. Then there was the auditor. A firm managing what was reported as tens of billions of dollars was audited by an accounting practice so small that the Inspector General's report treats its size as a red flag in itself. Any of this was checkable. None of it required a subpoena. It required somebody to compare the story to the world and notice the gap. On the 4th of February 2009, 8 weeks after the arrest, Markopoulos sat in front of the House Committee on Financial Services and said it under oath. I told the SEC exactly where to look, providing them with a long series of clear warnings that any trained investment professional would have immediately understood. Inexplicably, the SEC never acted upon those repeated multiple warnings over a 9-year time span. And then he said the part that explains the 16 years. The SEC is over-lawyered and has too few staff with relevant industry experience and professional credentials to find fraud, even when a multi-billion-dollar case is handed to them on a silver platter. Over-lawyered, not corrupt, not lazy, staffed with people trained to determine whether a form was filed correctly, facing a man whose forms were always filed correctly, because they were. Every statement balanced, every confirmation matched. The books were immaculate. They were also entirely manufactured. The advisory business did no trading at all. Client money went into a bank account, and a back office produced the paper that made the trading look real. Trade blotters, customer confirmations, account statements, all generated after the fact for transactions that never occurred. A firm examined 5 times by the agency that regulates it. And what the examiners were checking was the paperwork. It ended on the 11th of December 2008. Madoff was arrested and charged with 1 count of securities fraud. He pleaded guilty on the 12th of March 2009. On the 29th of June, Judge Denny Chin sentenced him to 150 years, and the number entered the language. $65 billion, the largest fraud in history. That number is not what anyone lost. 64.8 billion was the total shown on customer statements as of the 30th of November 2008. The last month, the firm printed them. But those statements recorded gains from trades that had never happened. The figure is the sum of the fiction. The money that people actually handed over, minus what they took back out, was a fraction of it. The trustees' work has centered on that number. Real cash in, real cash out. And it is roughly a quarter of the headline. Sit with what that means. The most quoted statistic about the largest financial fraud in American history was produced by the fraud. We repeated the account statements. Even the number was a document nobody checked. Here is what the real one looks like. Irving Picard, the trustee appointed to recover what could be recovered, reports approximately $15.4 billion recovered and about $14.5 billion already returned to customers with approved claims, around 73 cents on the dollar of what they were owed. 17 distributions, and the work is still going. That is a better outcome than almost anyone expected in 2008. It is also 17 years of litigation to undo what 5 examinations failed to prevent. Now hold the 2 documents side by side. One is 32 pages, written by a competitor with nothing to gain, titled "The World's Largest Hedge Fund is a Fraud," delivered to a federal agency in 2005, correct and filed. The other is a monthly customer statement. Immaculate, balanced, internally consistent, and describing trades that did not exist. False and accepted for decades. The agency read both. It closed the file on the first one. And this is the pattern in every episode of this channel. The system is built to verify that a document is complete, not that it is true. A complete lie passes. An incomplete truth does not. Nothing about that architecture changed after 2008. The forms are still checked for completeness. Somebody still signs them. The fraud was never hidden. It was submitted twice in 2005 and marked closed. Every episode of this channel begins the same way. A document that was written, filed, received, and ignored. Enron buried it in a footnote. Theranos put it above a signature line. Boeing deleted it from a manual. Volkswagen left it off a form. Subscribe. The next one is another paper trail that was public the whole time.